Okay, I guess we can all hear me, and the sound check's good. I'd like to welcome everyone to Trading Markets Option College, Session 2, Lesson 1. My name is Joe Corona, and I'm coming to you from India tonight, where I'm working on a project. I want to welcome you, and I hope you'll enjoy it. A word about some of the material we have. You've already seen it. It's on the website. Everything we talk about will be archived. It's there for your review. I know that, particularly in the markets this morning, with the events that occurred in London today, that a lot of people probably have a lot of stuff to do, and we'll have to come back and listen to this some other time. With that in mind, everything we do is recorded somewhere. It's either stored for you in a PDF document on the website, and all of these sessions are archived for your review at your leisure. Without much further ado, this first lesson is basically going to be an overview of what we're going to be doing throughout the course. It's fairly meaty. It's got a lot of material. It's a lot of review, a lot of intro, and generally my classes always tend to run long because the option material gets to be pretty intricate and detailed. So the way I'm going to do this tonight is that this first class will actually end up being Lesson 1A and 1B. I'll go about an hour and a half tonight, and we'll go about as far as we can go, saving some time at the end for questions. And then we'll reschedule the rest of Lesson 1, probably for next Monday, although I'm not sure about that yet. We'll get back to you on that. So tonight we'll go about an hour and a half. So this is Lesson 1, and we'll consider what we're going to look at today, Lesson 1A. As always, I'd like to save the questions for the end, and you'll also be able to email me with any questions you have, and I'll get them back to you straight away. So without wasting much more time, let's get rolling. Just a little introduction about me. I've been in the markets now. This is my 25th year. I began as a runner on the CBOE in 1980. Started at the very bottom, and I began trading equity options on the CBOE in 1982 as an arbitrage trader. I moved to the CBOT, which is the Chicago Board of Trade, to trade bond options in 1984, and in 1987 I started a proprietary options trading group. We ended up having about 30 traders dispersed through several different exchanges, including the CBOE, CBOT, CME, and Life, all focused on options and options trading. At that time, functioning as pit traders. I've traded for various bank and proprietary trading operations. Traded over-the-counter and exchange-based European fixed income options. I spent 4 years in London working for a British investment bank, running their options desk. I then went into the electronic realm, and I've been a Boone, Bobble & Schatz futures and options trader on the Eurex platform. I still dabble in that a little bit. And I left that in 1980 and rejoined one of my friends and colleagues, Tony Saliba, at Saliba Co. We ran a proprietary equity options trading group there for a couple of years, and then shifted over to run the Dynamic Hedge Fund, which is an options-focused hedge fund, also run by the Saliba Group. And then I left there to go out on my own and start my own little project here, which is trading the Indian futures and options markets from India. Which is where I'm talking to you right now. I'm in the lovely Pune, India, where I'm running a trading operation teaching local Indians how to trade futures and options and engaging in proprietary trading here of their markets. So that's my background. I've basically traded options on damn near everything, any type of equity, commodity, bond, currency, anywhere in the world. I've probably traded it at some point. Pretty much my career has been split in half, 50% pit trader, 50% proprietary trader from off the floor. So I have experience on both sides of the fence. I know both sides of the game, and I'm preparing to help you understand who's motivated by what and where they're coming from. teaching and training. Some of the things I've done, I work for the International Trading Institute, which again has Tony Saliba's options training center that he put together in the late 80s, early 90s. I've been an instructor there since the early 90s. I've trained people from pretty much every continent, with the exception of Africa. Delivered courses in North, South, Central America, Europe, Asia, and Australia, basically focusing on what it is to run an options book and market making as a business. So it's more from the market making angle. While I was with Tony, I also authored and published the Daily Alerts, which is a web-based option advisory service geared toward retail traders. It's offered to customers of Schwab and TradingMarkets.com at the time. And I was also a feature writer for an weekly instructional magazine called Intrinsic Value, devoted to option trading strategies and education, where I wrote the option trades for technicians in the strategy session columns. Okay, and that is what I'm going to kind of focus on in this course. Basically, strategies and tactics in the spirit of the proprietary trader. We know that we're not market makers. We're never going to be market makers. We're not going to get the edge like market makers get the edge, so we've got to try and work from a different angle. So that's what we're going to introduce here, and that's pretty much going to be the theme throughout this course, is going to be combining option strategies with different types of trading methods. Okay, first of all, let's review who's involved in the option market, what their motivations are, and what their roles are. Okay? The first group of people, and this is the group that I belong to for the first half of my career, are the price makers, the people who post the prices. Market makers, liquidity providers. They're paid to provide liquidity by capturing a theoretical edge based on whatever their pricing model is. Okay? So they're paid to put up prices, and the way that they're compensated is by capturing a theoretical edge determined by their studies and their pricing models. Okay, they take this theoretical edge and theoretical money, if you want to call it that. They manage the risk and they try and turn the theoretical money into real money. Their business model, their edge, is a small edge, small theoretical profit with very large turnover. That's their business model. Okay, those are the price makers. Price takers are the other side of the fence, okay, and this is going to include us. Price takers are hedgers, end users, day traders, and other time frame traders. Their motivation is based on a completely different edge, okay? The first group, the price makers, their edge was completely model driven, okay, based on flow and based on their analysis of volatility and what they thought the individual options were worth. These people, the price takers, have a completely different edge. Their edge could be fundamental, it could be technical, or it could be an information edge, inside information or other type of information. So in their mind, they've got an edge created by something different. You know, whether it's fundamental or technical knowledge or inside information or other information, their edge as they approach the market is this type of information. So they don't have a problem giving up the traditional edge that the market maker, meaning crossing the bid-ask spread and buying the offer or selling on the bid, because their edge is completely different. They're operating from a completely different perspective as the price maker. So the price taker has basically got a different view and a different perspective on things than the price maker. Okay? All right, let's talk about why a retail option trader loses. Okay, why do retail options traders seem to lose all the time? Okay, and the main thing in my experience, and one of the reasons I know these things is because I've done them. You know, most of the sins that I'll preach about in this program, in this class, are sins that I've committed. So I have firsthand knowledge, and there's no teacher like experience, believe me. Okay, one of the reasons that option traders tend to lose is because they don't have a system. Options are very, very sexy. You know, the idea of being able to plop down some money and having limited risk and the possibility of unlimited upside in the case of a call is very, very sexy and hard to resist, and you tend to just take these things, purchase them, scatter them, forget about them, and trust to the luck of the gods that one of them is going to come through for you, like lottery tickets. Okay, people tend to get lazy and not apply a rigorous system to their trading, like you would when you're doing the underlying. Okay, so the number one reason is no system. There's nothing telling them to get in, and there's nothing telling them to get out. If you don't have a reason to get in, you're not going to have a reason to get out. If you don't know why you're going long or short, you're not going to know where you're wrong and when it's time to leave. Okay, so one of the reasons, in my opinion, why the retail option trader loses is because of the allure of options, the fact that they're limited risk. They tend to get sloppy and lazy, and they don't have a plan. They don't have a system to trade these things. The second reason is the wrong strategy. Okay, if there's going to be an up move, a down move, or a sideways move, you have to consider all the time not only where the move is going to be, what direction, but what type of move it's going to be. Is it going to be a slow move? Is it going to be a fast move? Is it going to be large magnitude, small magnitude, moderate? You have to consider all these things, and then you have to implement the proper strategy, which is really what this class is all about. We're going to look at different types of trading situations, and then we're going to look and see what the optimal option strategy is for each type of situation. Okay, so and I've done this myself. I'm sure many of you have. You've got the wrong strategy, you get basically the right size, wrong shape. You get some kind of buy signal from your systems, or from however you go about making your decisions, and then you plop down and buy some calls, and it turns the market rallies, and you don't make any money. Okay, because you failed to take into consideration some other outside parameters, such as volatility. Okay, so fail to consider the type of move and use the wrong strategy. Should have been doing a bull spread instead of buying calls or something like that. Okay, failed to consider the volatility situation. Okay, so you have to look at the playing field. Every time you receive a signal, or every time you get a message that you should be taking a certain type of trade, if you're going to use options, you have to do more than just consider up, down, or sideways. You have to consider the playing field. What does the volatility situation look like? Is the implied volatility historically high? Is it historically low? Is it mid-range? What does the term structure look like? What type of move am I expecting? All these things go into your decision-making process when you're selecting an option strategy for a certain type of situation. Okay, so a quick overview of what this course is all about. This is a discipline that I like to call tactical options trading. Okay, what we're doing is we're combining technical system trading with options. So we're going to introduce throughout this course a series of well-researched and well-tested, back-tested methodologies for trading. We're also going to introduce some of your own toward the end of the course. And what we're going to be doing here really is we're going to be looking at and using these things as kind of like examples. We're going to be looking at different types of technical trading systems, and then we're going to go through and methodically fit the system with an option strategy. Okay, so we're going to give you some, you might give us some, but what you're going to walk away with at the end of this course is you're going to be able to take any type of trading method, whether it's your own, whether it's store-bought, whether it's something you pick up from this course. You're going to be able to take any kind of technical trading method or any other type of method and be able to retrofit an option strategy to it to optimize that strategy for options. Okay? Technical systems give you a reason to make a trade. Technical systems give you enter and exit parameters. Technical systems give you an edge. And what we're going to, basically the theme of this course, options plus trading equally balanced. A lot of times when you take an option course, it's all about options, nothing about trading. You take a trading course, it's all about trading, nothing about options. We're going to try and put the two together in this course. Okay, so combining options plus trading, it's like peanut butter and chocolate. Okay, tastes good together. Okay, why should we use options? Why should we even bother with options? Options are a pain in the butt. I've heard that said, I've said it myself. Okay, but why do we want to use these things? When we can just take underlying positions. I'll kind of finding out today a little bit. Number one, risk control. Long options and long option spreads have limited risk. Much better for individual equities where you have issue-specific risk. It's one thing when you trade indexes, that have very, diversified index, and you don't have that situational risk where, a specific company can blow you out of the water. But when you trade individual equities, where any kind of news can come out overnight in either direction, down or up, options and limited risk option spreads are much better for individual equities. Your ultimate risk can be predetermined. Okay, you can decide how much you want to allocate to a certain trade ahead of time, and you can allocate that much and that's it, and you can sleep at night. Okay, I don't know if you can see this chart very well. This is the stock that some of you are probably familiar with, a little fly-by-nighter called Taser. And if you look at this, and you look at the traditional trading strategy, you can see how Taser was pretty much hugging this nice trend line here. And if you'd bought it every time it came down to this trend line and put a stop a little bit below, you did pretty well. And then the day came when it came down to the trend line and, it completely collapsed. And if you had a stop in, chances are it got filled somewhere down here. Okay, so when you're trading, risky individual equities, option strategy here, a limited risk call or a limited risk call spread, will allow you to sleep at night. Continuing, next one is leverage. Okay, you can use less capital and give yourself much more firepower with lower priced options than actually investing in the equity itself. And one of the best things of all, opportunity. You have opportunities in a couple of different dimensions that you don't have when you just trade the underlying. You have price opportunity, and you also have volatility opportunity. So it translates into price opportunity of the underlying going up and down, and you've got opportunity of the individual options themselves going up and down. So you basically have a game of a couple of different dimensions here taking place that you can get involved in. Continuing on, staying power. Long options allow you to hold against initial setbacks. They allow you to participate during volatile periods. Scalability, and this is a really important one. We can take the building block approach at entrance and exit. We can work into positions. We can work out of positions. We can make mid-trade modifications. We can start out with one type of position, and as our opinion of the market changes, we can adapt to it by changing our option position along with it. If we start out with possibly a buy signal and a long call, and we make the trade, and then halfway into the trade, a couple of days later, the market's moved, and we decide now the market's going to behave in a different way, we can modify that. We can turn that into a bull spread. We can turn it into a butterfly position. We can turn it into all kinds of different trades. So with options, you can make some really nice mid-trade modifications, and your positions can be morphed as market condition or your opinion changes. Continuing with Y options, flexibility. Market view is no longer restricted to up or down. You can play direction. You can play magnitude, velocity, timing, volatility levels, meaning just the absolute level of implied volatility, whether it's high or low, and volatility shape, meaning the structure of both the skew and also the term structure between months. Okay, so that's Y options. Now let's talk about how options work. And this is, I brag about this being a Greek-free course and a math-free course, and it's really not. I mean, there will be some of that. There will definitely be some Greeks. There will definitely be some math. But one of the things I really want people to grasp from this course is kind of a feel, a way of feeling how options work and understanding how options work. That comes on a level that's not mathematical. So you kind of get an understanding of how options work and how the strategies work, and then you'll have a better feeling of how to apply them, and you'll then have a better understanding of when to apply them. Rather than just popping everything into a calculator and calculating the delta, gamma, vega, theta, we just kind of want to have an understanding of how things work, okay? And the best way that I can explain it, that I've explained it in my courses that I've taught, is options are like little insurance policies against an event. You've got premiums, and most of the option terminology comes from the insurance industry. Okay, so it's insurance against an event, and the event would be traveling through the strike, in the designated time period, meaning by expiration. So each option has a premium, each option has a term. You can have comprehensive insurance, which would be a deep in the money option, or you can have catastrophic insurance, which would be an out of the money option. And the same things that affect the pricing of insurance policies affect the pricing of options. Okay, and you have to think about some of the strategies in terms of insurance. You'll find that helpful, and I'll point that out as we go along, and we'll give you a little bit more understanding, especially when we're talking about options of different maturity, diagonal spreads, calendar spreads, and things like that. How does volatility impact option prices? Okay, well, if we think about the insurance policies, rising perception of risk. Okay, volatility is risk. You've got a much larger spread of possible outcomes. That means the risk of traveling through the strike rises. That causes the premium to go up. Okay, it would be as if that fire insurance policies in your neighborhood, and all of a sudden houses in your neighborhood started to spontaneously combust. The perception of risk, volatility comes into the market, the perception of risk rises, the premiums rise. Reinsurance costs. What does it cost the price makers, meaning the market makers? What does it cost them to lay off their risks? Okay, if there's no optionality, or if there are no options available for them to lay off their risks, their bid-ask spreads are based upon risks in getting the execution of the underlying, and also their reinsurance costs, or their costs associated with hedging their option positions. Okay, so if it costs the price makers, meaning the market makers, more money to hedge in the underlying market and more money to hedge in the option market to hedge their positions, then they're going to raise their volatilities and they're going to raise their premiums that they're asking for, and that's going to cause a domino effect throughout the entire market. Okay, and the fire analogy, again, you have to look at perception of risk. There's specific risk and there's general systemic risk. It's one thing if there's one fire in one house in one neighborhood. That's not going to cause everybody else's fire insurance premiums to go up. Okay, but if there's a general situation that's causing a lot of fires, such as brush fires, forest fires, possibly you live in an area that has seasonal fires, then that's a systemic risk, and that's going to cause a general rise in all the premiums of all the options. Okay, so that's what volatility is. Volatility is risk. Okay, going back to the insurance analogy. Option prices are composed of intrinsic and extrinsic value. Extrinsic value is the time value, broken down into time value, which is carry, dividends, so on and so forth, and insurance value. Okay, so volatility impacts the insurance value. When volatility goes up, all options go up. Okay, because it raises the distribution of probable outcomes. Okay, that means there's a greater range of probable outcomes, and with the asymmetrical payout of options, that raises all option prices. When volatility goes down, all the options go down. Okay, let's look at a graphic example of that. Here's a graph of a long, you might recognize, of a long straddle. Okay, and if we look at the profit and loss of the straddle, which basically is the price, we can see how volatility impacts the price of this straddle. With 0% volatility, which is essentially expiration day, you can see the hockey stick risk-reward payout that you probably see in your classic textbooks and option literature. 0% volatility, meaning that there is not going to be any movement. The outcome is defined. There is no range of outcomes, and what you see is what you get. So basically 0% volatility equates to expiration day. Now you can see with the red line here 30% volatility and see how the option prices are increasing. 60% volatility with the blue line, 90% volatility with the green line. So all option prices go up when volatility goes up, and they go down when volatility goes down. Okay, that's one thing to keep in mind. The other thing to keep in mind is it affects, that location is very important. This happens to be a 100 straddle. Okay, and we can see that the gain in price at the 100 strike is much greater than it is the 95, the 90, or lower or higher strikes. Okay, so options are sensitive to rising and falling volatility depending upon location as well. The at-the-money strike is always the most sensitive to any changes in any of the parameters we're going to look at. Okay, what are the different types of volatility we're going to be dealing with in this course? Okay, the first one we're going to look at is historical volatility. Historical volatility is a measure of a stock price's movement based on historical prices, usually on a close-to-close basis. It is the annualized standard deviation of daily returns over a given time period. Okay, and it's the measurement of how prices are dispersed about a mean. Basically, how much the stock moves around. I've put some sample calculations on the website. Really, this number, historical volatility, is offered by pretty much every charting package, every option service, every brokerage house on the planet. So it's not really necessary to be able to calculate historical volatility yourselves. However, if you're curious and you want to, go have a look on the website. I put a sample calculation up there. Second kind of volatility we're going to be looking at is implied volatility. Okay, implied volatility, and this is a really, really important concept. Implied volatility is the option market, meaning the market as a whole, option market's opinion as to a stock's likely volatility through expiration. Okay, so you have buyers, you have sellers, you have price takers, you have price makers. And as the trade goes back and forth during the course of a day, and implied volatility fluctuates back and forth, it eventually reaches some sort of equilibrium. And that equilibrium, when the buyers are satisfied, the sellers are satisfied, and they both sort of neutralized each other. That equilibrium for that moment in time is the market's consensus opinion as to what the volatility is likely to be for that underlying between that point in time and expiration date. Now it changes continuously, and any news that comes out can impact that, and anybody who has a different opinion can take a position. But that's what implied volatility really is. It's implied by current option pricing, and implied volatility changes continuously as market opinion changes. If you want to look at implied volatility, you can go to basically the website of any exchange. You could go to the iVolatility.com website that's up on our website. The link is there. And free option calculators are available. And all you do is you pop in an option price, and you pop in the parameters like the underlying price, the days until expiration, strike, and so on. And it'll pop out the volatility for you. And that's the implied volatility. Okay, now what is the link between historical volatility and implied volatility? Okay, one basically looks backward. Historical volatility is the past. Implied volatility is the future, or it's the best guess of the future according to the market participants. Does the implied volatility have to be right? No, it almost never is. Okay, but at that particular point in time, it's the best guess of the market participants as to what they feel volatility is likely to be up until expiration. One of the behaviors that volatility exhibits is that it's serial correlated. It's got strong autocorrelation. That means that past behavior is correlated with future behavior. Okay, so this is where the link between historical volatility and implied volatility comes in. Past behavior impacts future expectations, and remember that future expectations are embedded in implied volatility. So naturally, historical volatility at some point is going to impact implied volatility. Now, when you find implied volatility deviating, far away from historical volatility, it's usually because some event or some lack of events are going to take place between that particular point in time and expiration, such as something that's going to cause, higher volatility or lower volatility. An example being, earnings, news announcements, economic reports, anything that comes between the current date, today, and expiration might cause implied volatilities to trade a little bit higher than historicals. On the other side of that coin, if you're heading into slow periods, post-earnings periods, summertime such as August, holiday time such as Christmas, you can see the implied volatility trading well below historical volatility because the market participants have factored into the equation the fact that it's likely to be slow over that period of time. So, the link between the two is there, but remember that implied volatility also, even though it incorporates some information from the past, it also incorporates information from the future. So it doesn't necessarily have to follow implied volatility. It can trade at a substantial discount. It can trade at a substantial premium at any time, depending on what the future looks like to the market participants at that time. Okay, here's a graphic example, and this is from the iVolatility.com website, and we'll be using iVolatility.com a lot in this course. I think that everybody should take an opportunity to at least go look at the site, follow the link up on our website, and go there and read the material. There's some very good material that's available there for free. Take a look at what they have, see if you're interested, maybe get a trial subscription, try it out, and see how you like it. There's some great information on this site, very helpful, and if you're going to make option trading your business, you are going to need access to this type of data. It doesn't necessarily have to be from them, but you will need this type of information from somewhere. Okay, so it's worth having a look, check it out, and maybe you'll find it useful. We're definitely going to be using a lot of the material in our course. Here you can see the relationship between the historical volatility. In the blue, we have the 30-day historical volatility, and in the beige or the brown, we've got the implied volatility index mean, which is basically kind of a generic calculation of a 30-day implied volatility. And you can see here, initially, the implied volatility is a little bit higher than the historical, and the historical kind of goes up, and you can see the implied volatility and historical volatility kind of follow each other there. But then the relationship completely falls apart, and the implied volatility trades well below historical volatility, and the historical volatility actually turns and follows the implied volatility down later. So here, you can see that the implied volatility is kind of leading the show. Okay? Now, what's going on here? Why is implied volatility trading at such a premium here and such a discount here? Well, this happens to be, if you can see all the way down here, this is April. This is earnings time. Okay, so this took place back in April. So remember that implied volatility is forward-looking. The market participants at the time were pricing options at a premium because they saw that there was going to be some volatility coming, namely in the form of earnings reports. Once the earnings season was over, the implied volatility collapsed, and eventually the historical volatility followed along. Okay, so you can see the relationship. Sometimes it's got a fairly tight relationship, and at other times it can go in completely different directions. Another thing we've got to know about volatility is it's got a very strong directional bias. In stocks, and in the indices, and also in things like bonds sometimes. Volatility has a strong inverse relationship with direction, okay? And on this chart here, you can see we've got a couple of line charts. In the blue, we've got the 4 Qs, and in the black, we've got the NASDAQ 100 Volatility Index, and the QQV. And you can see how basically I can almost draw a line right down the middle here, and they're practically mirror images of each other. So basically, when the stock market goes up, volatility in general goes down. When the stock market goes down, volatility goes up. Okay, this is very important to us. Volatility's got a very strong directional bias in stocks. Okay, another thing we're going to need to be concerned about is the implied volatility skew. Basic option pricing models assume a log-normal distribution of prices, and empirically that's not the case. Stocks and indices exhibit negative skewness. They exhibit a leptokurtic distribution, meaning that they spend more time around the mean than they should, and they also spend more time out on the tails of the distribution than they should. All of these things combined have basically caused the market to adopt a skew. Okay? Another factor of implied volatility skew, supply and demand. Okay? Hedging. Okay, a lot of the hedging that takes place in the equity market is in the form of zero-cost collars. Now, what a zero-cost collar is, it's a strategy where you buy an out-of-the-money put and you finance it by selling an out-of-the-money call. This puts upward pressure on the lower strike volatilities and downward pressure on the upper strike volatilities. And it's also another contributing factor to the skew. And it helps create that well-known smile that we've seen. Okay, so here's an example of the smile. If on the x-axis here we've got the underlying price, and on the y-axis we have implied volatilities. Okay, and you can see when we're graphing this, you get the smirk or the smile. Now this was taken, I think this was taken about a month ago, but this is the SPX. And you can see that in general, the lowest point of the skew, or the lowest point of implied volatility of any particular month, is right around the at-the-monies. Okay, and then the below-the-money options with strikes below the current underlying price traded successively higher implied volatilities. Okay, the above-the-monies tend to trade at lower volatilities, so that's the smirk or the smile. So the implied volatility skew is also going to be another big factor in our decision-making process. Some of the characteristics of the skew in the equities market, the skew is swimming. Now what that means is, or it's a sticky delta skew. The skew tends to move along with the market. Okay, and this is going to be important when you're constructing option positions, especially spreads. Okay, if I back up here and we look at the skew again, this skew will move along with the market. Okay, meaning that if suddenly the SPX went from 1,200 down to 1,000, this shape would go with it. That would mean the new point of lowest implied volatility would be 1,000. So this entire structure would shift. Okay, and that's the swimming skew. So basically, as the market moves back and forth, this middle low point moves back and forth and drags this entire structure back and forth with it. Now that's important when you're constructing, especially vertical strategies, knowing that, you know, if I took this skew right here, for example, if I purchased a 1,200 call and the market went up to 1,300, I would know that my call would probably be trading at a volatility that's somewhere up here. Okay, that's important information. So the skew is swimming, or it exhibits sticky delta tendencies. It ages. It changes shape as it ages. And later on in the course, we're going to look at a way to compare the apples and the oranges and the walnuts and kind of normalize this aging process so we can kind of look at the skews across different maturities. but it definitely ages, changes shape, and gets steeper as you approach expiration, flattens out as you go out further in time. And it's absolutely impacted by the supply and demand that I mentioned earlier, the hedging, the zero-cost collars. Okay, here's an example of the skew aging. Remember, this was taken about a month ago. I probably should have updated these, but this is the July 05 SPX. So this is about a 1 month skew. This was taken about a month ago. And you can see at that time, the low point of implied volatility was about 10%, and then it kind of slopes upward. So the 100 point out of the money lower strike was traded at about 20%. If you look at subsequent months, you can see how August gets a little bit flatter. Okay, and the volatilities, the implied volatilities of the lower strikes come down. The slope is not quite so severe. And as you go forward in time, the skew gets progressively flatter and flatter. There's December 05. Next is December 06. And you can see how the skew gets flatter and flatter. So the skew definitely changes characteristics over time. All of this will be incorporated into our option strategies that we're going to apply to certain methods. Okay, the next thing we have to get acquainted with is implied volatility term structure. Different expirations have different implied volatilities. Remember that implied volatility is a function of the market participant's perception of what kind of movement is going to take place between now and the expiration of that option. So naturally, different time horizons will have different implied volatilities. Short-term behavior is reflected in short-term option pricing. Longer-term behavior is reflected in long-term option pricing. Okay, so as the different maturity options react to different types of events, they will find different volatility levels, and what this does is it creates a term structure. And this term structure is really, it's not unlike an interest rate structure where you can actually have a forward implied volatility, where different slices of volatility are implied for different forward start time periods. A concept that we'll examine probably about halfway through the course when we start to really study calendar spreads. Okay, so that's the implied volatility term structure, also going to be very important in our strategy selections. Okay, here's an example of term structure. This was taken at the SMH, and basically what you've got here when you're looking at term structure on the iVolatility.com site, you've got some generic maturities here, 0, 25 days, 50 days, 75, 100, and so on. And then you've got implied volatility here. So these are the at-the-money implied volatilities of different maturities. And you can kind of see, at the time the market was completely dead. So naturally the shorter term maturity options reflected the fact that the market was really dead. And then you can see how basically the longer term implied volatilities rose back toward the long-term mean. Okay, so short-term options always reflect short-term conditions. So if it's dead, they're going to be cheap. If it's cheap relative to the rest of the options, if it's volatile, they're going to be expensive relative to the rest of the options. Okay, so when you find this kind of curvature, it's an indicator that short-term conditions have been slow. Now, another thing we're going to be looking at are implied volatility cones. And the cones that we're going to look at, they aren't really the classic implied volatility cones, but we're going to be looking at a graphic that's supplied by iVolatility.com that allows you to take a look at a glance of the high and low implied volatility for options of a given maturity. Okay, and it's sort of similar to the cone structure. This will reveal at a glance whether current implied volatility of a given maturity is historically rich or cheap, and it also shows current term structure. Here's an example. Let me just flip forward to it. Okay, this is the example. This is what we're going to be looking at now. Let me just explain to you what we have here. What they've recorded in their database is the range of implied volatilities for certain maturities of options: 30-day, 60-day, 90, 120, 150, 180. Okay, so you've got the implied volatilities lows here, implied volatility highs here. So you can look at the historic levels of implied volatility, and then you can see what the current term structure of implied volatility is here. And what you're seeing here is you can see that there's been some sort of short-term volatility that took place in this market. As a matter of fact, this was IBM right after IBM took a nice little tumble a couple months ago. So you can see that the short-dated maturities reacted to that, and in fact, the 30-day implied volatility is basically on historical highs, okay, up here. And then you can see that, as mean reversion takes place, that the longer-dated implied volatilities go back down toward the long-term mean. Okay, but this allows you at a glance to see whether different maturities are historically rich or historically cheap, relative to their range. Okay, so these short-dated options here at this point in IBM were really, really rich, up near the highs. Whereas the longer-dated options were still fairly reasonable. When you look at something like this, you can get ideas for how you want to attack the positions. If for example, let's say that we're looking at one of the systems that's going to be supplied to us by the Connors Group, and we've gotten a buy signal in this, and we decided that we were going to explore, what strategy would be appropriate. Well, we certainly aren't going to buy 30-day call options, based on this type of volatility. In this type of situation with volatility up this high, we want to pursue a strategy that's both bullish and takes advantage of volatility being high, and maybe do something like a bear or a bull vertical, or possibly a call ratio spread, okay, or possibly a calendar spread. Seeing that the 120-day options are down here and the 60-day options are way up here, there's a possibility we might want to get into some sort of calendar spread. So we're going to be using this type of analysis a lot in determining what our option strategies are going to be for a given situation. Okay, so that was an example of high short-term volatility. Now here's an example of low short-term volatility. Okay, so here the shorter-dated maturities are trading at lower implied volatility than the longer-dated maturities, and you can see that it's near the lower end of its range. Basically 30-day option, the range of implied volatility for an option with 30 days to maturity has been basically from looks like about 8% up to about 16, 17%. Okay, and right now it's right down around 10. Okay, so in this situation, the roles are reversed, where the shorter dated options are historically cheap relative to the longer dated options. Okay, so volatility, putting it all together. When you're doing your volatility analysis, what do you need to look at on a trade-by-trade basis? First of all, what is your signal? Is it a buy? Is it a sell? Is it a sideways signal, which we'll actually have in this course? What's the time horizon of your signal? Is this thing going to happen quick? Is this a 5-day trade, a 10-day trade, a 20-day trade, a 3-month trade? What is the time horizon? What is current historical volatility? What is current implied volatility? How steep is the skew? What does the term structure look like? Is it backward, meaning that high short-term volatility, low long-term volatility, or is it the other way around? Okay, when you're analyzing volatility, when going through your option strategy selection, these are all the factors you're going to have to look at. Okay. How do we expect volatility to change if we're right? Okay, remember the inverse relationship between volatility and market direction. Okay, are we getting a buy signal? If we're getting a buy signal, then it would be natural to expect that if we're right, and we fully expect to be right, that implied volatility is going to decline on that rally. If we're getting a sell signal, we should be expecting implied volatility to go up. There are always exceptions. There's exceptions to everything with options. But in general, with the inverse relationship between volatility and market direction, we should be expecting that. How do you expect volatility to change if you're wrong? How will you react in either situation? This is the volatility checklist we need to have. Okay, so again, tactical options trading, we're going to swoop in, we're going to take advantage of certain situations, and we're going to apply certain strategies. So what are our weapons? Let's look at our core strategies and examine our arsenal. And this is by no means limited to this. There might be some other strategies that we'll do later in the course as well. Okay, but our core strategies are some of the basic ones. And, sticking with the, KISS principle, keep it simple. Sometimes the simple trades are the best ones. Long call, long put, those are obvious. Bull and bear verticals. Ratio call spread. You'll notice that there's no ratio put spread. Long straddle. Long butterfly spread. Long condor spread. Long calendar spread. Short calendar spread, and different diagonal calendar spreads. And it's not limited to this list. There might be others that will trot out in special situations. But these are our cores. Okay, a couple things. Why is there a ratio call spread and not a ratio put spread? Okay, remember the inverse relationship between volatility and market direction. On rallies, we can expect implied volatility to drop, which works for the ratio spread because we're going to be basically putting on a position that's both bullish and short volatility. But with a ratio put spread, you would have volatility working against you. When the market goes down, volatility goes up, and that hurts the ratio spread. So in this course, we will not be using the ratio put spread. You see that there's a long straddle and not a short straddle. We're not going to engage in things that expose people to unlimited risk. The call ratio spread does have unlimited risk, but I believe it's manageable. We won't be selling straddles or strangles in this course. Long butterfly and long condor spreads, but not short ones. Okay? The reason I don't use short butterflies and short condors is because I think there's more efficient ways to take advantage of that type of trade, which we'll explore when we get to. Okay? And we're going to use calendar spreads a lot. Okay? So there's long calendar and short calendar spreads, and there are basically hybrids called diagonal calendar spreads that we'll be using. Okay? So that's our core arsenal. Our core strategies. Okay, strategy selection. What is the checklist? Okay, this is the checklist we need to go down every time. When we receive a signal through one of the trading methods that we have of our own, through one of the trading methods we're going to supply in this course, through any type of trade, when you're considering putting out an options trade, you have to go down this checklist and answer all these questions. Some of them don't apply, but you should have this checklist for every time that you're going to put on an option strategy, and you should go through it. First of all, what is the direction? Okay, that's pretty self-explanatory. Magnitude. How large a move do you expect? Velocity. How fast is it going to happen? Is this going to be a quick move? Or is this going to be a zigzag? Is it going to be straight up? How's this thing going to move? Timing precision, okay? I'm getting a signal, I'm getting a buy signal, I'm getting a sell signal. How precise is this method I'm using? What is its track record? If it gives a buy signal on day 1, does the market move on day 2? Does it take 5 days? What's the window that we can look at? If I receive a signal, does it generally happen within 2 days? Does it sometimes take as long as 7 days? We need to know these things when we're choosing an option strategy to fit to this. What are the current implied volatility levels? Is it historically rich? Is it historically cheap? What is the current skew structure? Now this may not always be applicable. Is it steep? Is it flat? What is the structure? What is the current term structure? Okay, are short-term volatilities cheap relative to long-term volatilities, or vice versa? What are the expected implied volatility levels? Do we expect volatility to go up, go down, stay the same? What about the expected skew structure? Do we expect it to steepen? Do we expect it to flatten? Expected term structure. Do we expect term structure to change? If so, how? Okay, and what is our risk tolerance? So this checklist, and some of these may be more applicable than others for given strategies, but this checklist, we need to go through this checklist every time. Whenever we're getting ready to pull the trigger on an options trade, we need to go through this and answer these questions, and the answers to these questions will allow us to choose the appropriate strategy. Okay, so let's go through and review some of these strategies. For some of you, this might just be a review. Okay, but we need to keep in mind a couple of different things. When we're looking at these, the classic hockey stick risk-to-reward break-even graph is only applicable for one particular point in time, and that's at expiration. Anytime other than that, these structures behave in a completely different manner, and we need to get familiar with how each and every one of these structures behave through fluctuations of implied volatility and through change in time. And these are the things that I want you to basically inhale and understand and feel and know by the end of this course. How these different types of strategies are going to react to changes in volatility, changes in time, changes in underlying price. Okay, we need to know this. Okay, so first of all is the basic one. This is the long call. And here you can see the long call at expiration in the blue. You've got the classic risk-reward break-even of the long call, limited risk. And this is a long 100 call purchased at $5. And you can see that the break-even point is the strike price plus the premium you paid. Okay, so that would be 105. And then you've got unlimited participation on the upside. Okay, limited risk on the downside. However, if you go out from expiration, if there's any more days left until expiration than 0, you can see that the risk-reward payout of this thing changes. The value of this option and the risk-reward break-even and payout change dramatically as time until expiration changes. It goes from being a hockey stick to a curve. And here you can see the curvature, or the convexity of the structure. Okay, so this is very important. Long call versus time to expiration. Okay, now you might think you're looking at the exact same graph. Okay, and in a way it is. This is the long call versus volatility. So in lieu of expiration, I substituted 0% volatility, because what I really want you to understand here is the way that the passage of time and changes in implied volatility mimic each other. And they affect structures, they affect options, the same way. The passage of time and rising and falling volatility mimic each other with the way they change the risk-reward payout and the behavior of these structures that we're going to be trading. Okay, so we need to be familiar with that. So here you can see in the long call versus volatility, with 0% volatility, which is basically the equivalent of expiration date, you have the exact same payout. And then as I raise volatility, we go up to 30%, 60%, 90%. We can see how the payout changes, and so we can see how we get the curvature in the long call profile. Okay, almost exactly the same as when we ran time backwards. So an increase in volatility is basically equal to an increase in time to expiration, and vice versa. Okay, in the way that they affect option positions. Okay, so let's evaluate the long call at expiration. And for a lot of you, this is basic stuff in a review, but we need to cover this. The risk is equal to the premium paid. Profit potential is unlimited. Your break-even is the strike price plus the premium that you pay. That's at expiration. At any other time, it's different than that. Okay, but at expiration, this is your risk, profit potential, and break-even from a long call. When is the optimal time to use a long call? Okay, when we get a signal that tells us the direction is up. Okay, we're going to be go through the checklist here. Direction is up, magnitude is large, velocity rapid, timing precision good, Current implied volatility levels, cheap to fair. Expected implied volatility levels, steady to rising. Okay, what is the risk? The risk in a long call position is that the market goes down, that the market goes sideways, or you have declining implied volatility. Okay, let's just kind of go through these. Why do we need all these things? Well, up is obvious. We want the market to go up because it's a bullish strategy. We want large magnitude, rapid velocity, and good timing precision because time decay. Okay, if we're going to buy a call option, we want this move to happen, and we want it to happen quickly, and we want it to be big, okay, because of time decay. And the properties of the call take advantage of a large magnitude move and a rapid velocity move because of the unlimited profit potential of the upside, okay. Current implied volatility levels, cheap to fair. Well, we want to be buying cheap or fairly priced volatility, okay. Expected implied volatility levels, steady to rising. That helps us with the long call. Okay, now on a rally, will that happen? Probably not. Given the inverse relationship between volatility and market direction, we can probably expect volatility to decline on a rally. Okay, a little bit, but hopefully that'll get outperformed by the large magnitude move and the rapid velocity move up. Okay, let's look at the long put. Here we've got the long put at expiration. You've got the classic hockey stick graph here in the blue. And in the red, you can see once again I've manipulated time until expiration because I want to show you how that changes the payout of the put. Here we've got 30 days until expiration, 60 days, and 90 days. So you can see once again that the hockey stick disappears and you get the curvature of this position. Okay, so the risk reward and break even of a put anytime other than expiration is quite different than the classic explanation that you usually get. See my latency is going up again. Long put versus volatility, once again, it looks like the exact same graph, and I want you to take away from these, all of these, how time and volatility mimic each other in the way that they affect the risk, reward, and break even of different option positions. Okay, they mimic each other. So here we've got, once again, we've got 0% volatility, which is in essence expiration, 30% implied volatility, 60% implied volatility, and 90% implied volatility. And you can see how it changes the nature of this put position. So volatility going up is like time running backwards. Volatility coming down is like time running forward. The long put at expiration, your risk is equal to the premium paid. Profit potential is equal to the strike price minus the premium you paid. And your break-even price is also equal to the strike price minus the premium paid. When do we want to use a long put? Direction, down, obviously. Magnitude, large. Velocity, rapid. Timing, precision, good. Once again, we want this large, rapid move with good timing precision because when we purchase an option, we're going to be suffering the effects of time decay, theta, which we'll review later in the course. So we want this move to happen, and we want it to happen now. Okay, so we want our timing precision to be good. Other than that, if we thought the market was going down, but it might take a week or so, maybe we'd use something else like a bear spread, or some type of calendar spread. Okay, but if our indicator, whatever it is, whether it's one supplied by us or one supplied by some other service, if your indicator has good timing precision, then you can go with the long put. Current implied volatility levels, we want them to be cheap. Expected implied volatility levels, again, if we think the market's going down, we'll expect implied volatility levels to go steady or rising. Risk, long put, up, sideways, or declining implied volatility. Okay, those are the risks in a long put position. Okay, the next weapon in our arsenal are going to be verticals. First of all, let's look at the bull verticals. Now, I want to take a little bit of time and talk about terminology. It's very, very confusing. You hear a lot of different terminology thrown around with vertical spreads. Basically, when you buy a low strike option and you sell a higher strike option in the same month, in the same underlying, of course, it's a bull spread. Okay? Same class. So if you buy a low strike call and sell a high strike call, it's a bull spread. If you buy a low strike put and sell a high strike put, it's a bull spread. Okay, the difference is for one structure, you're going to pay money, and for another structure, you're going to collect money. Okay, so then long and short come into play. Basically, a long call spread, a short put spread, are both bull spreads. Okay, for one you pay money, for one you receive money, but the risk, reward, break even of the pricing of these should be identical. Okay, and we'll talk about how to differentiate between the prices of the two when we get closer to the point of execution. But for our purposes, they're identical spreads. Okay, long call spread, short put spread are both bull verticals. Okay, here's the structure. This is a long call spread. Again, short the lower strike option, or long, excuse me, my bad. Long the lower strike option, short the higher strike option. That's a bull spread. If it's in the calls, it's a long call spread. The long call spread at expiration, your risk is equal to your premium paid. Profit potential is equal to the high strike minus the low strike minus the premium paid. And the break-even point is the low strike plus the premium paid. Okay, bull verticals continued. Here's the short put spread. Now notice how this looks exactly the same as the long call spread. And that's because it is. The prices might be different. And one is made out of calls and the other is made out of puts. But the risk, reward, and break even will be exactly the same, dependent upon execution price. Okay, another thing I want you to see about this spread is the effects of the passage of time. Okay, now, here we've got a more complex strategy. We've got one long option and one short option. And the way that an option position is impacted by changes in any of the parameters, any of the derivatives, depends on location. Okay, if you're close to your long strike, your position will behave like a long option position. If you're close to your short strike, your position will behave like a short option position. Now, what do I mean by that? Well, let's take a look at this 100-105 call spread. Ooh, that's supposed to be a put spread. It's supposed to be a short 100-105 put spread. That's an error. I'll have to correct that. Okay, but down here, if we look at the effects of time decay, we can see we've got expiration, which gives you the classic hockey stick graph. And then we've got 10 days, 30 days, and 90 days until expiration. Well, if we're near the long strike, if we're nearer the long strike than we are the short strike, I can see that as time passes, it hurts the value of the spread. Okay? But if we cross between the boundary of the long strike and the short strike, meaning we get above 102.5, then I can see that the passage of time helps the value of the spread. Okay? So what is built into the assumption process when we're going to use a bull vertical? Well, we're looking for an up move, obviously. But we're looking for an up move with declining implied volatility. Okay? So if we get a bullish move and we get the declining implied volatility, that's a perfect situation for the bull verticals. Okay, the structure of the short put spread, once again, long the low strike, short the high strike equals bull spread. In this case, it's a short put spread. Examining the short put spread at expiration, Your risk is equal to the high strike minus the low strike minus the premium received. Profit potential is equal to the premium received. And the break-even point is the high strike minus the premium received. Okay, but if you put these together with the risk-reward and break-even and a long call spread, you'll find out that given the execution prices, they should be identical. Okay, when do you want to use a bull vertical? Okay, we just kind of touched on this a second ago. A bull vertical is basically a market view that's embracing a view on market direction and volatility, and a little bit of magnitude and velocity as well. So let's look at our checklist. When do you want to use a bull vertical? Direction up, magnitude moderate, velocity slow to moderate. Okay, so what you're looking for here is you want to see it move up, gently, gradually toward the short strike, and you like to see implied volatility decline. Timing precision here can be fair, okay, because a vertical spread, when you're buying one option and selling another, doesn't have nearly as much exposure to time decay and implied volatility like the outright purchase of a call or a put does. You can afford for the timing precision to be a little bit fair. So if you've got something that generates a signal that it tends to be off by 3 or 4 days, this might be the ticket. Current implied volatility levels, fair to rich. Okay, you'd like implied volatility to be a little bit elevated when you do this because you're building a position that has a two-dimensional view. You think the market's going to go up, and you think implied volatility is going to come down. Okay, so you would like implied volatility to be either fairly priced or a little bit rich. Current skew structure, low to average, not really applicable in this case. Expected implied volatility levels, we're expecting implied volatility to decline. Expected skew structure, we'd like it to be steady or rising to help support the long lower strike option and raise it up the skew. Risk, the downside, falling volatility near the low strike or rising volatility near the high strike. Those are the risks of the bull vertical. All right, bear verticals. Okay, the opposite. Now, once again, same type of terminology situation. If you buy a high strike and sell a low strike, same class, same series, same underline, you're making a bear spread. Okay, whether it's calls or whether it's puts, then it's a bear spread. Now, in the calls, you're going to receive money. When you sell the lower strike call and buy the higher strike call, you're going to receive money, and it's going to be a short call spread. Okay? In the puts, when you buy a higher strike put and sell a lower strike put, you're going to have to pay money. Okay, so that's going to be a long put spread. But a short call spread, long put spread are both bear verticals. Okay, so once again, take a look at the vertical here, and we can see the payout of the bear vertical. We got limited risk on the upside, limited return on the downside. Okay, risk reward break even, the classical hockey stick graph that you see at expiration. Once again, notice the effect of the passage of time on this spread. If you're near the long strike, which in this case is going to be the upper strike, the passage of time hurts the value of the spread. If you're nearer the short strike, which is the lower strike in this case, the passage of time helps the value of the spread. Okay? Location, location, location. Structure, long the high strike, short the low strike. In the case of calls, it's a short call spread. Short call spread expiration, your risk, high strike minus low strike minus the premium received. Profit potential equal to the premium received. Break-even point is the low strike plus the premium received. That's only at expiration. Okay, here's the long put spread. Same situation. You can see risk, reward, and break even of this is identical to the short call spread. And once again, you can also see the impact of time passing. And remember that volatility going up and down mirrors time passing. So here we can see that when we're near the longer strike, the passage of time hurts the spread. And that also means that decline in implied volatility would hurt the spread. And here, when we're near the short strike, the passage of time helps the spread, which means that decline in implied volatility would help the spread in this case. Here's the structure. Long the upper strike put, short the lower strike put, long put spread. The long put spread at expiration, your risk is equal to the premium paid. Profit potential is the high strike minus the low strike minus the premium paid. Break-even point is equal to the high strike minus the premium paid. Okay, now let's review when we want to use a bear vertical. Direction down, magnitude moderate, velocity slow to moderate, timing precision, fair. Okay, so once again, when we're using these things, we're looking for a mild move. It can come in its own time. Our precision doesn't have to be that good because our exposures to time decay and fluctuations in implied volatility are somewhat muted by the fact that we're buying one option and selling another. Current implied volatility levels, we'd like them to be fair to rich. Skew structure, average to high. Expected implied volatility levels, declining to steady. Expected skew structure, steady to falling. And the risk of a bear vertical is the upside, of course. Falling volatility near the high strike, rising volatility near the low strike. Okay, now what I want to do is I want to stop right here. I know that this material is pretty dry, but we kind of have to get through this and get on the same page and get grounded before we can go any further in the course. Like I said before, lesson 1 is actually a mother. It's a very long lesson, and it is going to be broken into 2 parts. It was broken into 2 parts before, so this is a good natural spot to stop. We've been going for not quite an hour and a half, and what I'd like to do here is stop right here. We'll pick this up on a date to be announced, most likely to be Monday, and finish the rest of the material in lesson 1. And I'd like to stop right here and open it up for questions, and then we'll resume this conversation probably on Monday. You can ask me questions now. If you're viewing the archives, you can email me questions. So let's just open it up for questions right now. Anybody have any questions? I'll take them because I'm sure you have quite a few. Anybody there? No questions? Okay, well, once again, if you do have any questions, you can email them to me. So I would encourage you to review the material on the website. I would encourage you to check out the ivolatility.com website and take a look at the products they have and the services they have there. I would also encourage you to take a look at the educational material they have there. They've got some of the best explanations of volatility and what volatility really is that I've seen. Have a look at that, check it out. You might want to take a 30-day trial and see what you think of the service. It's very helpful. Again, if you're going to enter into option trading as a business, you're going to need that type of information, so you might as well start getting familiar with it now and looking at it now. So I would encourage you to go there. And with that, good day to everybody, good trading, and we'll pick this up again on Monday, I suspect. We'll get an email out to you to confirm that, and in the meantime,